Today, we are gonna discuss the case of Archegos capital management and its dramatic collapse in 2021. Archegos Capital Management is a family office that mainly invests in the stock markets of the United States, China, and Japan. The founder of the Archegos Capital is Bill Kwong. He was a stock analyst at Tiger Management in the United States. Next is the background of this case. Let's start with the year 2021. This was the peak of Archegos Capital's growth phase. Instead of buying stocks directly, it used total return swaps, derivatives that gave it massive exposure without public disclosure. Banks like Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley, and UBS financed these positions, allowing Archegos to build up to $100 billion in exposure, despite managing far less actual capital. With their help, Archegos built highly concentrated bets in major companies like Vocam, CBS, Discovery, Baidu, and Descent Music. Now, fast forward to March 2021. The collapse began. Vocam CBS stock price fell, triggering margin calls. Archegos couldn't meet the collateral requirements and defaulted. To protect themselves, bank dumped shares in fire sale, which led to over $10 billion in losses globally. The Archegos case exposed the dangers of hidden leverage, lack of transparency, and regulatory blind spots, especially within family office.
Okay, thank you Cai Yutong for your explanation. Hi, my name is Jessica and now we're going to talk about the consequences, or we can say damage, because of the collapse of Archegos. First, banks face direct financial losses. Credit Suisse was hit the hardest, losing about 5.5 billion US dollars, followed by Nomura with 2.9 billion US dollars. Even major players like Morgan Stanley and UBS lost close to $1 billion each. Second, there was a serious impact on firm value. For Credit Suisse, this meant long-term reputational damage, a sharp drop in share price, and the resignation of senior executive. Nomura also faced major credibility challenges. Finally, at the market and industry level, investor confidence was shaken, especially in media and tech stocks, where Archegos most exposed. Regulators responded by tightening oversight on family offices, and derivative, and the incident raised serious questions about bank risk control and transparency. Next, we are going to discuss about the derivatives product use and their impact risk levels. This case was mainly driven by total return swaps, or TRS. These are derivatives that give full economic exposure to a stock gains and dividends, without actually owning the shares. By that, this structure created three major risks. First, hidden leverage. TRS let Archegos turn 10 billion US dollars into 100 billion US dollars of stock exposure. This was possible because only 10 to 15% collateral was required. Second, opacity and disclosure risk. TRS positions do not appear in regulatory filings, which meant neither the banks nor regulators could see the full risk building up. Third, concentration of risk. Archegos used TRS to make huge bets on a few stocks like Viacom CBS. When prices fell, margin calls and fire sales quickly led to its collapse. And thank you!
So why did Archegos risk management fail? Archegos collapsed because banks and regulators couldn't see its true leverage, which was hidden through the total return swaps. Prime brokers competing for its business lowered margin and collateral requirements, ignoring clear warning signs. At the same time, Archegos built highly concentrated positions in just a few stocks like Viacom, CPS, and Discovery, and risk models failed to capture how quickly this exposure could unravel. Finally, as a family office, Archegos avoided hedge fund disclosure rules, leaving regulators blind to the systematic risk. This case gives us three big lessons. First, the danger of hidden leverage. This emphasizes how crucial it is to increase disclosure and transparency in derivatives market in order to stop risk from being hidden. Second, leverage and margin rules must be enforced strictly, even if it costs short-term profit. Institutions must ensure that client leverage is closely monitored and controlled. Third, risk management must always come before revenue because weak oversight will hurt both Archegos and global banks. If we were in charge, we'd demand full transparency of client exposures, enforce prudent margin rules, and set limits on concentrated positions. Regulators should close disclosure gaps for family offices. Personally, the lesson is to invest cautiously, diversify, avoid unnecessary borrowing, and focus on liquid, transparent assets. So in conclusion, the Archegos collapse show how hidden leverage, weak oversight, and regulatory gaps can destabilize markets. Stronger transparency, stricter leverage rules, and better regulation of family office are urgently needed. Most importantly, long-term financial stability depends on prioritizing sound risk management over short-term gains. Thank you!